Good afternoon to all our friends out east, and good morning to all our friends out west. This is Larry Shavaro with First Associates, and we are presenting our second webinar in the Marketplace Lending Series. Today we have a topic: Successful Alternative Lending Strategies, Attracting Credit Funds to Your Marketplace Lending Platform. It's my pleasure to share the webinar today with David Johnson, the CEO of First Associates, and our special guest, Chris Johnson, Managing Director of Prospect Capital, who is not only a client of First Associates, but a very nice friend as well. A couple of quick housekeeping. The first webinar, which took place on August 11th, had many viewers and many folks looking at the website after the fact, and it is still up on the First Associates website and our YouTube channel. The webinars, for a little background, were developed from a few surveys that we've done at some of the meetup events for marketplace lending, and we asked the audience, number one, would they be interested in having webinars, and number two, what topics. And so our first webinar had Securitization 101 for marketplace lending, as many securitizations have been evolving. And then our second webinar here is Attracting Credit Funds. And today we have double the audience that we did the first webinar, and many folks, many new platforms are on, waiting to hear from David and Chris. The agenda today is David and Chris will present for approximately 15 or 20 minutes, and then it will be followed by a 10-minute Q&A. And so during the webinar, if you have any questions, please send them over. We'll be compiling them throughout the webinar, and then we will ask the questions for the Q&A session at the end. As well as after today's webinar, you're going to receive an information to complete a brief survey where we'll ask you for your suggestions for upcoming webinars, and so that we can constantly bring you content that's relevant to the marketplace lending industry. Stay tuned for upcoming webinars. Our next webinar on November 11th will feature two very successful platforms, which will share some of their success with the group. You'll see a webinar in early 2016 on origination charter banks, a securitization Part 2 webinar, big data, and other topics as we see the suggestions. And then find First Associates at these next upcoming conferences: Crowdnetic in New York on Monday, Lend 360 in Atlanta in October, Power Sports Finance Auto Finance Summit, and Money 2020 in Las Vegas in mid-October, AltFi and the American Banker Conference in November. And look out for the next San Diego meetup, dates to be determined based upon the holiday seasons. So let me just share with you, next slide, Rose. Let me just share with you a little bit about First Associates. First Associates is the largest third-party servicer in the marketplace space today. We work with over 80% of the platforms, as well as the institutional investors buying whole loans, providing warehouse facilities or leverage in the space. We work with many of the Wall Street and U.S.-based firms. The company was founded in 1986, was purchased by David Johnson, myself, and Scott Sharman about 6.5 years ago. We've grown from 6 people to about 140 people. We're doubling our space and continuing to support marketplace as well as auto, RV, marine, all consumer lending assets except mortgage and credit card. We provide loan and lease servicing, backup servicing, custodial work, UCC filings, and contract verifications for the industry. Next slide, Rose. And it is my pleasure to present our CEO, David Johnson. David is one of the principals, as I mentioned, at First Associates, and we'll be starting the webinar today and going through a little bit about why somebody would be, why an institutional investor would be looking to invest in one of the platforms. So, David, take it away.
Thank you, Larry. Next slide. So usually I like to start out with just a short bit about First Associates' position in the marketplace vis-a-vis the investment funds. And I think having seen the invite list and the participation list for this webinar, I know many of you have seen this slide or the sign that is usually present at the conferences we're at. And if you look at this, you can see that we really regard ourselves as having two sets of clients. One set would be the originators, whether that be a old line company like Yamaha who's in the captive finance space, whether that be Loan Depot with their new consumer finance program, which we're also the primary servicer for, or other companies like Avant, Lending Club, Prosper, all the usual participants. And the other clients that we have are the funds. Next slide. You can see that we have really built our business around relationships with the funds and the originators both, and it's been core to understanding what makes it tick between those funds and those originators, whether it be a fund like Prospect Capital, and of course you'll hear from Chris, or whether it be Eaglewood. We did the first backup servicing of a takeout of a Lending Club deal with Eaglewood back in 2013, which is where the flow forward agreements really started. Or whether it be with Colchis or BlackRock or the investment banks like Morgan Stanley and Goldman Sachs. Next slide. Having said that, there are several things over the years that we've learned about why investment funds are interested in origination platforms and how that interest culminates in what they're interested in looking at during their processes. And I think in a lot of ways some of this sounds a bit like mom and apple pie, because a lot of it is kind of the flavor of, well, you have to have a good business. And we'll talk some about these things. But I think what most origination platforms don't often realize is that the investment funds are not there to buy a batch of loans. The investment funds are there to form a relationship with an origination platform, which will result in an ongoing flow, an ongoing and growing flow of healthy loans over a long period of time. Their primary concern is to be able to put money to work. And you get right down to it, that's why they're there. And they want to be able to do that in the most leveraged way possible, not meaning financially leveraged, but meaning that from one relationship, they can get a growing supply of high-quality, high-performing loans that they understand and that they're comfortable with. So understanding and being comfortable with what does exactly that mean in this context. First off, you look at the business platform itself. Many of these things are the same as an equity investor would look at. It needs to fill a real need in the market. So we're not talking about someone who simply wants to be the next Ron Suber at Prosper, or who has a product which is simply a different maturity term or a different rate, but something which actually does fill a need in the market that is different. A company that has a robust understanding and deployment of technology. I think we've all seen companies that have been stymied by their lack of understanding or deployment of technology, or were just simply flawed from the beginning because they created something that was not sustainable over time, whether that be a proprietary technology model that as the mods somewhat snowball into the future becomes unsustainable or unscalable, or a model where you can't simply go in and create new products because you're very much gated in what you can do with it. A strong team, obviously, same as an equity player would look like, and real staying power. And in that, I mean that if a business platform is going to survive, it needs to have adequate funds to go forward and continue to originate and service the loans, or if we're servicing the loans, it could be that it just needs to be originating those loans. But it needs to have the staying power to be around for a prolonged period of time so that the institutional funds can be assured that there is some longevity there. 2, advantaged business model. In I won't say many years, but in the years that the marketplace lending business has been around, you can see quite clearly that from an origination platform, there are 2 ways to create sustainable competitive advantage. One is an advantage customer acquisition model. And we've all seen companies like Lending Club and Prosper come out and have first mover advantage and create the scale. And they got there first, so they can create scale where they have an advantage just in the general market. And we're past that point. Now we're having entrants come in like Loan Depot, who has a tremendous customer acquisition flow through their other mortgage business, which gives them a big advantage. We also see companies coming in who are doing purchase finance deals with specific retailers, which gives them an advantaged flow. But absent some proprietary or advantaged customer acquisition flow, it's very difficult to go out into the general market and create a sustainable growing company. The other alternative is superior credit decisioning. If a company can prove that they can do this, if they can actually look at the same pool of people that everybody else is looking at and make better credit decisions, that's a significant advantage. Next slide. On the compliance front, some of this is somewhat obvious, but the institutional funds will want to be able to see through the compliance program to see that the compliance is actually being done. This is also what an equity investor would look for, and it's what the institutional funds look for. And when I say that the compliance needs to be built in, not bolted on, you often see examples of funds where they come up with a product, and then as an afterthought to that product, they'll figure out how to make it comply. They'll give it to the lawyers and say, okay, give me some rationale which makes this comply and maybe tweak it a little bit. It's very important to come up with products that are actually compliant from the get-go, that are built to be compliant, and then a system that stands behind that will be compliant. There's a whole issue around licensing versus bank charter, which I think Chris will be speaking to, so I won't go into detail, except to say it's a major consideration which one of those paths that you go forward, especially given the recent Madden decision. On an investor program, number 4, it's very important to commit to an investor program. It's very important to commit to it in such a way that you're in it for the long haul, you're in it for the marathon, so that the investors who are there and who are coming to buy loans know that you will also be there tomorrow and the day after that. They'll be able to continue to purchase loans, and they'll be able to continue to receive a level of service from the platform that makes sense for them going forward. Investors are very, very much like customers. They need to have those relationships nurtured. They want to buy product that fills a particular need in their market as well. So whatever it is that you're thinking about in terms of what you'll be flowing forward to those investors needs to fill something that they need as well. It's much easier to think about them as customers than as investors. They're simply just on the other side of the equation. That's my short piece. Next slide. I'm going to hand it over to Chris Johnson of Prospect Capital Management. First Associates and Prospect have had a long history of working together, and we have had great success in doing so. Prospect is active in whole loan investment programs across both consumer and small business loans. And Chris, I will hand it to you.
Thank you very much. Rose, next slide, please. I'm first going to do a little bit of an overview, and then I'm going to get into a little bit more detail in terms of the vein of attracting investors to the program. One thing I do want to reiterate that David talked through was our view, and I think many investors' view, is that it's really forming a relationship with the platform. I would tell you that these forward flow programs and other programs that we have take a huge amount of effort. It's a lot of work on the investment side, on the legal side, on the tax side, and also on the accounting side. So we really put ourselves in that effort, and it really helps to form a relationship. And we very much appreciate the relationship that comes back to us. I'll also say that Prospect may be a touch different than some other investors. We are very much an asset aggregator. What I mean by that is we like to increase our volume, and we would like to hold our assets for as long as possible. We're not in this to create a trading business or to sell the assets. So we very much do our diligence from a very long-term perspective, and I think that may come through in terms of the next couple slides. So in terms of when investors look at your program, what would they, first and foremost, what should they look like? What should they look at? I think one of the basic things is, there's really consumer versus small business. We're involved in both. There's different risk returns, obviously, with each of those. And then I think within small business and within consumer, there's developed a broad array of different products. So The beauty of this marketplace is that an investor can create really what they want along a spectrum of return and risk. So if an investor wants a higher yield or a higher current yield, they will have to accept the higher risk. There are different ways to do that, both in the consumer side and the small business side. Conversely, if an investor says, I really want to create something that has potentially in the future, once we have a downturn, much lower volatility, I'm willing to accept the lower yield. So there's a way to do that, and obviously, that's by buying prime and super prime consumer, and maybe the most prime of the small business side. So it really is, what does that investor really want out of a program? I think our view is we want to look across the board, and the reason we can do that is we spend a lot of time to have leverage facilities, which enables us to look at some of what I would say the lower risk instruments, but be able to create an acceptable return for prospect because of the use of leverage. So that's creation of a program. I think a due diligence program I'm going to get more into on the next page. I would tell you that any investor, and I totally understand the sensitivities of not wanting to undo the cloak too much, but an investor will want to have some kind of visibility into how a platform underwrites the loans that it facilitates and originates, and then what is the risk, how does that delve into the risk aspects of the platform and of the instruments that they create. So we're going to get into all the functional areas that would be diligenced. I think one main point is, while we diligence as an investor a lot of areas, at the end of the day, they have to sort of work holistically together. So we can talk about the 6, 7, or 8 areas of diligence, but it all has to work together in terms of enabling the platform to create increased volumes. Returns to be generated and costs established. One of the main things from an investor standpoint is, do they want to really look at unlevered returns only, or do they want to look at levered returns? And I think when we first approached this business close to 3 years ago, we were very focused on unlevered returns, and that was because there was no really such thing as leverage. And we were fortunate enough early on to get into some formative discussions with Capital One, where we ended up with two Capital One credit facilities, and those are what I would call standard revolving credit ABL facilities. So we were able to create levered returns on really prime rated consumer assets, as an example. There's a lot of work with respect to creating a levered return. I would say it at least doubles the amount of effort put in by an investment team. And then the other flip side of leverage is, and this really started about maybe 18 months ago and started to accelerate 12 months ago, is that investment banks are more willing to consider warehouse facilities leading to securitizations. I can remember when 2 years ago I could literally hardly get investment banks to return my phone calls. And then when they did return my phone calls and we had a conversation, there really wasn't that much to talk about. But I have seen what I would say almost an extreme acceleration in the last 12 to 18 months. But again, the investment banks are very focused around ultimately creating the securitization. One thing to be sensitive to if you're a platform, and obviously you're very focused on cost yourself in terms of building the platform, but an investor, and again, this may be a question you may want to ask an investor if they start talking very seriously about a forward flow agreement, is have they really worked through the costs of establishing their program? We're all learning to some extent in this, and frankly, one of the things that I've learned over the last year in particular is there is a cost to establishing a program, and what I mean by that is much more than just the leverage costs. But I would tell you at Prospect, we fully load our investments internally, and what I mean by that is we have the efforts of Prospect Legal, Prospect Tax, Prospect Accounting. We have outside counsel, and this is all before. This is just really around the normal investment process, and then around the the leveraged process. And then if you end up doing securitizations, and we have done one unrated securitization on our on-deck facility, on our on-deck assets, the securitizations create another layer of expenses that is multiple counsels, et cetera. But I think one point is the cost should not be underestimated by any investor going into this. So if you're a platform and you're having those discussions with investors, it may make sense at some point to ask them if they've really, when they come back to you with returns and risks, have they really looked at all the costs? I think next slide, Rose, please. So this is a little bit how we approach due diligence, and again, it's probably pretty consistent with a number of other investors that would like to create sizable forward flow programs, and particularly other investors that are very focused on asset aggregation and longer-term holds or long-term holds. So one thing that we always get asked at Prospect is, do you underwrite the individual loans, whether they're small business or consumer? The short answer is no. We don't feel that we have, we're not a hedge fund that's basically trying to pick off certain amounts within the risk ratings. What I would say, though, is that our efforts are put much more strongly into underwriting the different risk ratings. So we spend a lot of time around the risk ratings of each of the platforms, trying to really understand how that is underwritten, what's the relative risk. And what happens also is that this underwriting is very much an ongoing process. I don't really want to leave the impression that we come in, do our due diligence, and we're done, and we sort of put our feet up on our chair on the desk. Portfolio management is very important to what we do, and I think to what most investors do. Portfolio management is an ongoing process. Sometimes platforms would maybe call it an invasive process. We monitor our portfolio on a daily, weekly, and monthly basis. We have different ways to do that. And we also have and this goes back to the relationship question, very regular interactions with the platforms that we invest from. And that interactions enable us to continue to update our returns, our vintage curves, our loan loss analysis, and we do a lot around that in terms of the loan loss analysis and by risk rating. So I would say we spend our efforts really on the risk ratings. I mentioned the functional areas earlier. Due diligence topics, these are really meant to highlight what I would call functional areas. I would say that in the last year, David hit very much upon marketing and marketing channels. I would say a real focus in the past year on our side has been not to sort of make light of others, but the underwriting, the risk, and then obviously the regulatory and compliance. Servicing and collections, not to state it lightly, but we assume that that's going to be done, according to, quote, servicing standards. We really do spend a lot of our time on the underwriting risk and the regulatory. And clearly we want to know if we're going to be able to develop a large volume forward flow program with a platform, really what are the marketing channels? What's their special sauce? What are their channels? Onshore versus offshore, I think many investors look at potentially trying to create offshore structures. That's what we've done. We use an onshore trust and an offshore trust. It probably makes the documentation and the loan purchase agreement and the loan servicing agreement slightly more complicated. I would say where it basically makes the world much more complicated is on the credit facility side. And again, the platform gets involved in that to an extent because there's a thing called a multi-party agreement. So when leverage comes on board, there's a multi-party agreement which brings the platform into that. I think the main point on onshore versus offshore, other than the fact that it does complicate a bit, is this is all so that we can have what's called a seasoning period, so that we typically season our loans I would say for a longer period than most other investors, and then after we feel that they've been seasoned appropriately, we can sell them offshore. Regulatory, I mentioned earlier, that has been obviously it was always very important because of the business model of the state export. Madden on May 22nd, while myself and Prospect and our lawyers and the platforms can say it was a terrible decision, the reality is it was a decision. So we all have to deal with it collectively. We, and I'm sure you all on the line, have spent a lot of time with lawyers over the last, really since May 22nd, on this, and I think that time will tell whether there will be some solutions that develop or whether solutions need to be developed with the state export. Again, everybody's got their own opinion on this, and I know that a number of people are doing a lot of intense regulatory work on this, but it's clearly served to highlight regulatory and compliance. Roles of outside parties, unlevered versus levered versus securitizations, that really is meant to highlight that as you move from the left to the right there, it becomes much more complex. There's more parties involved. I won't say it's exponentially becomes more complex, but it is, I have found it, it's more difficult in a securitization to get 5 or 6 sets of lawyers to agree on documentation than in a levered facility where it's sort of 3 sets of lawyers, and in an unlevered facility it's sort of 1 or 2. So again, we're all sort of learning this a little bit. Documentation continues to evolve. I would say documentation is, I don't ever want to use the word standard, but it's fairly customary for credit facilities and for warehouse facilities that have been developed over the last couple of years, and it's still continuing to evolve a bit on the securitization side. And then on securitizations, of course, there's slightly different documentation requirements for a rated transaction versus an unrated transaction. For assets in terms of leverage, what I have found to be very interesting over the last year particularly is that the banks, and I put banks, when I say banks, I mean banks like Capital One, Texas Capital, Bank of the Internet, First Tennessee, et cetera, have become more open towards providing leverage below, on the consumer side, below the prime rated assets. So the near prime assets, which typically start at 660 or 640 and go down to 600, the banks have become much more receptive to providing leverage on that. They obviously aren't going to provide 78 to 80% loan to value, but it's very helpful that they have been providing leverage on the near prime. And then on securitizations, I mean, you all have seen the rated transactions. Generally, you can get slightly more leverage on an unrated transaction than in a credit facility, which is to be expected, and then maybe even slightly more leverage on a rated facility. But again, I think we'll see those items mature and develop over time also. I think on the small business side, to the extent you all have been involved in that, whether it's rated or unrated, the leverage is significantly higher than the consumer side. So the leverage is in the 90 to 95% area. And the reason for that primarily is that most of the small business that's been done is short-term loans, and those have very fast vintage curves. And so you can run any kind of scenarios where there's, even at that higher leverage, the risk is acceptable, or it's deemed to be acceptable by those that purchase the fixed rate notes. The future of marketplace lending, we are very excited to have gotten in. We were certainly not as early as some other folks getting in as investors, but we're very excited about the future. And, I continue to believe that whether it's consumer or small business, that the commercial banks are, they've got other issues to work through. They've also got other areas where the regulators continue to have wanted them to focus on. So I actually think while this is not dependent upon solely the banks not being as actively involved as they were many years ago in consumer lending or small business lending, I do think that each of those sectors is a very large pie and a very large addressable market, and it's out there for us to take and invest in. With that, Rose, I'll finish up the prepared remarks. I guess next slide, please. I'll turn it over to Larry.
And thanks, Chris and David, and thank you for the insight. This has been a very interesting approach from the due diligence. First question that as we move into our Q&A session came over, it was from a few folks, will we be receiving a copy of the slides? And yes, all attendees will see a copy of the slides tomorrow with a recording, and then it will also be up on our First Associates website and YouTube channel. Here is a question from our friends at the Orchard platform for Chris. Chris, what has been your approach to due diligence, and how many due diligences have you completed for some of the platforms?
Sure, and that's a very good question. Again, I sometimes say so much about due diligence that I think people's eyes start to glaze over. I would say now again, this goes back 3 years. When we went on the Prosper platform, we diligenced it for 8 months. I would say that's fairly typical. We can diligence it much faster than that, but it's really reliant upon getting the material that we need. And again, it's really understanding each of those functional roles that I talked through. We have kept track of how many platforms we've done diligence on. And not every one of these we did 9 months on, but we have spent time in diligence 26 different consumer platforms and about 10 different small business platforms. So part of our approach has been to end up to really spending a lot of time with a platform and then being able to purchase additional assets within that platform. I think one oversight that I did not make, and this goes back to the relationship point that David made, is when we go on a platform and invest in a platform, we're hopeful that there will be other products developed by that platform so that we can efficiently invest in those. And so whether that's on the consumer or the small business side, I think platforms are developing a number of, it's funny, the investor like us wants the platform highly focused on the instruments and investments that it creates, but the flip side is we say, geez, we'd like to buy more, so we'd like to go into a platform and broaden out a bit.
Okay, thanks. Here's the next question. It's come from 2 or 3 platforms, and I'm going to try to put it together here because it's a little bit of an approach here. So it's a question for David, and basically they're saying, if a fund is buying loans from our platform, why do they care so much about our platform and our company and due diligence? They really own the loans at this point, and so if we went away, they would still have the loans.
Got it. Well, I think that I'm sure those came over kind of midpoint in the webinar or something. Certainly after listening to Chris's description of what it takes to actually diligence a platform, I think it's probably fairly obvious to everybody that if you go through that process as a fund and you only get a certain number of loans and there's no opportunity for additional loans, or the opportunity to receive additional product looks like it might be somewhat muted, it's just simply not worth it. You really want to have relationships with companies that are going to be growing and that are going to produce more product that you can buy, and you want to have relationships where you know that the quality of the relationship is going to be good and the amount of due diligence and cooperation is going to be maintained or grow over time as the relationship grows.
Yeah, I would add also. Go ahead, David.
Sorry, I was just going to throw in that I mean, I think there certainly are players in the market who are focused on buying, batches of loans, small batches of loans, and I think that that's a completely different set of players than the kind of flow forward players that we're talking about today.
I would also add that obviously we worry about the quality of the loan, and so part of the quality of the loan is intertwined with the stability of the platform. So I think it weaves into that also.
Well, great. Here's another question. This is for David. You showed a chart with all of these different funds. How do I reach decision makers at these funds? Where would I get started to do this?
Well, that's a really good question. I think that the way that this world works is fairly organic. It often takes a recommendation or an introduction from someone who knows someone at the fund, who has a relationship with someone at the fund. Certainly for our part, we do quite a bit of introductions. We actually just in the last several months have taken in 3 startups who had loan portfolios of less than 1,000 loans. We've brought them on in a primary servicing role for us, and we've kind of helped them work with other players to fix up their origination platforms. And then we've gotten significant over $100 million flow forward agreements with various funds for these players. I think that's one way to go about it, not necessarily just with us, but with other players. Another way is to simply make sure that you're in the flow of conferences and that you have an opportunity to meet these people, whether it be at one of our meetups or whether it be at a conference. It's important to make a personal connection, hopefully facilitated by someone that they already know. Chris, I'd be interested in hearing your take on that question.
I totally agree. I think conferences are important. I know we all at some point get conferenced out, and I think Larry and David more than anybody maybe. But if banks have gotten more active in the last 2 years, including investment banks, so they're happy to make introductions also. But I agree with you. It's sort of grassroots relationship building.
Great. And I'm going to have one last question because we are a few minutes over. I'm going to ask both Chris and David for just a 30-second answer for your predictions for 2016 for marketplace lending.
Sure,
David,
I'll go first.
Go ahead.
I'll just say that I think that there's a couple of different things that are happening that are exciting in marketplace lending in 2016. I think one is certainly from our point of view, we are working on a large number of securitizations right now as we speak. Some are rated, some are unrated, but there's quite a variety from a large number of players, and not just a large number of players on the origination side, but also on the investment fund side. And I think that 2016 will really be the year that the public capital markets open up to marketplace lending in a very substantial way. I also think that when you look at marketplace lending, it is basically a stack of functional units that are operating as individual companies, just like Intel and Microsoft did back in the days of the computer. And marketplace lending is now going through that same phase where the marketplace lenders versus the banks, somewhat like Chris talked about, are battling it out, and marketplace lenders are gaining share. And I think that 2016 will also be the year where we see an inflection point there where this becomes the de facto business model for consumer finance.
I agree with what David said. I also think that there will be clarity on the regulatory side because there's a little bit of murkiness now. I think there will be some clarity. There'll be some slightly different models at the originating banks that develop. I wouldn't call them anything dramatic. I think there'd be a little bit of an evolution. I also am very excited about the growth that's going to occur both on the consumer side and the small business side. I think that we have reached the inflection point on growth also.
Great. Chris and David and all of our guests out there, and Rose, thanks for setting this up. Thanks very much for attending our second webinar in the Marketplace Lending Series. Look out for our next on November 11th, and kindly fill out the survey at the end so that we can bring you more content. Have a great day today, and again, thanks for attending.
Thank you, Larry. Thanks,
Thank
Chris.
you. Thanks, Larry. Thanks, David.